Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Mike Reynolds, Vice President of Investment Strategy at Glenmede, to discuss if equities are priced to perfection. It's great to have you with us, Mike. Welcome to Trade Talks.
Happy to be here.
All right. And of course, that's a key question. Before we get into that, let's talk about expectations. Anything material coming out of next week's FOMC meeting?
Well, Jill, I'll tell you what, I feel like I'm sort of living in this bizarro world where the Treasury's quarterly refunding is getting actually a little more attention than the FOMC meeting this week. But going into this meeting, expectations are pretty low for any sort of incremental new information from the Fed this week. Now, if inflation expectations continue to fall, they almost have to start considering cuts. Otherwise, real Fed funds rates tick higher, and it sort of makes their policy stance just even tighter. But investors know rate cuts are coming this year. It's just a matter of when. It feels much too early to be cutting rates at this meeting or really making adjustments to the quantitative tightening process. Now, marketings seemed to be getting ahead of themselves, pricing and rate cuts starting in March, but they've since backed off on that a bit. Our base case is we start to see small 25 basis point cuts in Fed funds starting this summer. We don't expect much in the way of hints or clarity on that path this week, from the statement at least. But as always, we'll see what Powell is willing to share on his thought process at the press conference right after. And just to circle back to that first point, we'll get that quarterly refunding announcement today at 3 from the Treasury, which actually has a decent amount of focus to it. We expect they're still going to come out bills heavy, but the question investors are asking themselves is how far the Treasury can go in bills composition as a percentage of total outstanding. They're at about 21% right now, which is outside of that 15 to 20% range that the markets have gotten accustomed to.
Right. To your point, it does feel like a bit like bizarro land, if you will. If you could give a high-level overview to the audience of why this is getting so much focus, what's the significance of this on a high level?
In terms of the bizarro world on the Fed outlook?
No, not the Fed outlook. Why that's kind of being overlooked. And to your point, what's happening at 3 o'clock today? Why on a high level is the market focused on this and really kind of ho-hum when it comes to the FOMC?
Because it's such a big change on the refunding announcement that we saw toward the end of last year, where the Treasury was really going out of its way to issue on the short end and perhaps shore up term premiums on the longer end. It seems like, again, the Fed is really expecting not to do too much at this meeting. So investors are really focused on something that we're normally not focused on, which is that refunding announcement.
So the key question is, are equities priced for perfection, or do you think that they overshot rate cut expectations? I mean, we clearly saw the move at the end of the year, the past 6 to 8 weeks, all markets, not just equity markets, really had a big run there. I mean, does it have the potential to be a sell the news kind of event once we first get that rate cut? It seems as if a lot has been priced in here.
We're kind of putting it this way. Equity valuations have essentially crossed the T on perfection. By our estimates, valuations on large cap equities now sit at the 80th percentile, which actually isn't too uncommon for an economy that sits in the late stage, but it just doesn't seem to be accounting for any risk to the macro story whatsoever. Part of that may be some overexcitement on just how soon and just how much we may see in the way of rate cuts from the Fed this year. But the other part seems to be just this Goldilocks outlook for the economy that just leaves so little room for unexpected events. That could be escalation in the Middle East, or maybe even something completely out of left field. What's sort of interesting, though, is that not all corners of the market are actually behaving this way. Those premium valuations on large caps are particularly concentrated in mega cap growth, which sits above the 90th percentile. Now, value stocks comparison, well, they're not quite at a discount, appear just incrementally more fair at this point in time, around the 70th percentile. Now, it's really interesting when you start looking at small caps, they look even better. They basically sit right at fair value in our framework. But we caution that their economic sensitivity could actually make for some pretty bad timing before getting too excited about small caps.
So, Mike, has the environment normalized in terms of how investors are getting compensated for taking on risk?
So this risk return trade-off that we're so used to talking about is kind of operating in this fantasy land where up is down and down is up right now. In a normal environment, investors should be compensated for taking incremental risk in their portfolios. It's pretty foundational to finance. Just think through a simple 3-asset portfolio with me: stocks, bonds, and cash. When you move from cash to bonds, you take on that interest rate risk. But investors right now are just still seeing higher yields on cash. And when you take that jump from bonds to stocks, you take on that risk inherent in the equity risk premium. But we're in an environment right now where bond yields are pretty competitive with earnings yields on equities. Now, between those three assets, there should be an upward slope in returns in a normal environment. But this just seems like a pretty abnormal environment we're finding ourselves in. From our perspective, that's the backdrop of incentives that investors are facing right now. And look, investors should be taking advantage of those incentives by underweighting stocks in favor of bonds and cash at this point. Those starting point valuations are often the single biggest determinant of future returns over the long run. So when you have that valuation discipline, it's got to be a cornerstone of the investment playbook, and you have to act on it.
And finally, how impactful will the tax bill be on the market?
Well, it's progress in Congress. It kind of feels a little weird to put those words together these days, but here we are. There does seem to be actually bipartisan support picking up steam on this thing. We think it could be decently impactful for markets this year. Even though it actually looks deficit neutral over a 10-year horizon, the main injection of stimulus would actually occur in 2024. Now, that includes things like tweaking the rules on business deductions, affecting things like R&D, the ability to expense capital equipment, other interest deductions. But there's also some changes on the consumer side to the child tax credit. Altogether, by our estimates, the leading indicators for the economy itself continue to point to actually a pretty challenging year for the US economy that could actually see a contraction in real GDP at some point this year by our estimates. However, the other side of this is that incremental stimulus that comes from the bill. And we think it's large enough that it could offset some of that risk, but it's not a complete offset. This doesn't necessarily completely take that recession risk off the table, but what it could do is it could soften the blow on the severity if that recession does hit. So we think what's going to be one of the most interesting things on this actually is the interplay between monetary and fiscal policy as it comes out of this. It's actually hard to imagine a scenario where all of this fiscal spending this year doesn't show up as at least a little bit inflationary to some degree. The question then becomes whether it's enough to change the Fed's calculus on rate cuts. To a larger extent, we don't think it's going to have a material effect on their path on rates, but it could be a factor that just causes them to be a touch more cautious as it takes rates lower this year.
All right, Mike, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.